Hello friends, welcome to the new edition of Knowledge Series. Today we are going to understand categorization of different risks in the financial markets and understand how to measure them. Now very often we have seen when investors build their portfolios or take investment decisions, the return potential of the asset class or the product drives the decision. However, the second most crucial aspect, which is the risk factor, is often ignored. After all, risk and return both go hand in hand, and different risks can affect the portfolio in different ways. So today we are going to understand 6 different types of risks that an investor needs to factor in while they are taking their investment decisions. Which are these risks? Equity risk, credit risk, liquidity risk, interest rate risk, foreign exchange risk, and event risk. Now let's understand what is equity risk. Equity risk is commonly referred as market risk, which means the potential loss in your portfolio due to fall in the equity market. Now there are several measures of equity risk. Let's understand some of them. The first one is beta. Now beta is nothing but a measure of volatility with respect to its benchmark or the market. By definition, the beta of market is 1, which means if your stock or a mutual fund has a beta of more than 1, which means it fluctuates more than the market. If the beta is less than 1, which means it fluctuates less than the market. Now it helps an investor to understand how sensitive is your portfolio with respect to the market or its benchmark. The second measure of risk is standard deviation. Now standard deviation also calculates the volatility of your portfolio. Standard deviation is nothing but it measures the variation from your average expected return. Now let's take an example. Let's say there are fund A and B, both delivering an average returns of 15%. However, the standard deviation of fund A is 10%, whereas the standard deviation of fund B is 20%. In this case, it indicates that fund A is less volatile and it will tend to deliver returns which are closer to your mean, which is 15%. However, fund B is more volatile and it is more riskier since the standard deviation is 20% and it will tend to deliver returns which are little away from your average expected return of 15%. The third measure of risk is value at risk, commonly referred as VAR. Now VAR is a single risk measure that quantifies 3 variables. First, what is the maximum potential loss? Second, with what probability you can get that loss? Third is over what time period. For example, if you see a portfolio or a stock which has a 3% VAR with a 95% confidence level over the next 1 month period, it means that this stock will not depreciate more than 3% with a 95% certainty over the next 1 month period. VAR helps you decide, is the possible gain worth the maximum potential loss? At Anand Rathi, one of our sample portfolio targets a 14% return with a 9 standard deviation, 0.57% beta, and a 1% VAR with a 95% confidence level. In our next video edition, we will be talking about credit risk generally associated with a company's financial health, usually needed to be assessed while buying bonds and debentures.